Good morning, everyone. Nice to see everyone again today. So it's the 5th anniversary of We Are In conference. And I just wanted to start by a big thank you to the ECB for the great hospitality for the conference, to the entire organizing team, and in particular to the locals, Katarina and Agnese, and also to Carolina, Fiorella, the BIS, the entire program committee, and also obviously to all of you here, all the speakers and discussants, and to the CEPR staff, Petra and Despina. Now, it is my great pleasure to introduce Philip Lane, with member of the Executive Board and Chief Economist of the ECB. Philip's career is so extremely distinguished that I'm not even going to try to list all his achievements. Besides his key role at the ECB, Philip's intervention in the public debate are always very clear and substantial. I read all your speeches. I always find them extremely enlightening. I should also mention that Philip is a CEPR Research Fellow since 2002, and so that's a great achievement. He is an extremely well-cited international macroeconomist, and for example, all of us know his famous paper on the voracity effect with Aaron Turnell. He has also been a very important pioneering contributor in the new open economy macroeconomics with new Keynesian models. He has obviously also extremely influential work on the external wealth of nations with Gian Maria Milesi Ferretti. That has been absolutely path-breaking work in international macroeconomics and finance, and certainly it has greatly inspired my own research. So Philip, I'm delighted to welcome you here on stage.
So let me thank the organising committee for inviting me. I'm really happy to be able to participate, and I think the programme both yesterday and today has been really excellent. I think that poster format at lunch yesterday was really effective. Unfortunately, for some reason, after this speech, I have to go to the executive board and kind of make decisions about the budget and so on for the ECB. So I won't be able to stay here. And let me thank Hélène for the very nice introduction. I think we're of the same generation, so we've kind of, which is very nice as you get older. It's very nice as you get older to have people who've been on the same generational cohort as you and to really explore these topics. In any event, what I want to talk today, because again, this is a macro finance conference, and the topic of how monetary policy transmits is really at the intersection of macro and finance. So what I want to do is really, if you like, uncover the veil behind a lot of the monetary transmission analysis that is done here at the ECB. So let me thank the group of ECB staff who've really put together the analytics I'm going to show. So I'm just the reporter here. The actual work gets done by the ECB staff. The nature of monetary policy is we meet every 6 weeks, which means that a lot of this analysis is basically in a perpetual update. It's a perpetual update because the same models are kind of re-estimated, reassessed every few weeks. So again, for those of you both in central banks and academia who develop analysis, develop models, you may not get cited by us because a lot of that work is confidential, but there really is a kind of exploitation of the intellectual property developed by the macrofinance community. Okay, so in any event, and on the ECB website, you can read the full speech, but I'm not going to stand here and read very technical sentences, which might be a bit difficult for you to follow, and also it would take too much time. So what I'm going to do is kind of convey with some of the main charts and so on from the speech. Maybe my download count can go from Hélène. So usually my speeches might get one download. I now know it's Hélène to more than one download, in the online data. So let me just start with a very basic issue. And I'm not so sure the other central banks articulate how to make monetary policy in the same way. But this is a standard paragraph in our monetary policy statement. And if you like, we've decided we're not going to provide forward guidance in the sense of saying, look, all else equal, we think the interest rate, the dot plot or the interest rate is going to be X, Y, and Z if conditions are maintained. But what we want to do is to help the outside world try and, if you like, have the ability to, if you like, reverse engineer or shadow what we're doing. And so what we say is, what is the goal? It's 2% in the medium term. It's not 2% every quarter, but in this incredibly precise phrase, the medium term, we want it to be at 2%. We say, in line with what I just said, we're going to not pre-commit. So in every meeting, we're going to look in an integrated way at the data and then make our decision. And you might say, well, tell me the data you're going to look at. And it's going to be the inflation outlook. And I think you can think of that like as the most likely part. What is the base case for inflation? The risks surrounding it. And of course, I think everyone now is elevating emphasis on this issue, which is, okay, maybe that makes sense under the baseline, but are you sure it's robust to any particular list of upside and downside risks? And then a cross-check with the underlying inflation dynamics. And what I want to focus on today is the strength of monetary policy transmission. Now, I don't know how many of you have tried to think about that question. How does monetary policy transmit to the economy? And then you get into a lot of questions. Is this a systematic monetary policy, which is predictably responding to some shock to output or inflation? Or is it a monetary policy surprise, where compared to what the market expected, you've done something surprising? So that most basic anticipated versus unanticipated is there. It very much depends, and maybe I'll come back to this throughout the speech, in terms of if you look beyond the representative agent. And there's a lot of hank thinking at the ECB, because of course it depends on whether, and behavioral economics as well, it depends on whether people are really forward-looking. So the expectation of an interest rate hike 5 years from now matters for behavior today, versus people who are more heavily discount the future and are more focused on the actual policy decision. It varies a lot across models, and every so often I think the ECB staff publish, here's how much investment moves, consumption moves, inflation moves to 100 basis point shock, depending on the macro model you use. And that idea of model robustness is also very important. So with all of that is you cannot say, I have the perfect model, I read off the monetary policy impact of that model and I'm done. It makes more sense to really understand what's happening in the data, and that's what I want to try and do. So maybe the first step in that sequence is to ask, is monetary policy effective in moving the broader set of financial conditions? I mean, obviously, if you're paying attention to the current developments, there's a big debate in the US about whether the impact of the equity markets, private credit and so on, means that monetary conditions are looser than might be expected from the policy rate. So that's a very basic cross-check, is when we move the interest rate, do we move broader financial conditions? And how do we aggregate financial conditions? It's basically the best predictors of future inflation and output. So it's the elements of financial conditions that predict where output and inflation are going in the future. And that's why it's a macro financial conditions index. So in the left panel there, the orange line is our policy rate, and the blue line is the overall index. And you can look at that in two ways. One is, it looks like there's a strong correlation. So a lot of the time, the policy rate does seem to drive financial conditions, but there are plenty of exceptions. So there are exceptions during the global financial crisis, at the start of COVID, and so on. So what I want to emphasize here is when you think about this index, which is kind of normalized to zero, what we've had now is when we started hiking is a really big change. we went from accommodative to tight very quickly. That's a steep movement, both in the policy rate and in financial conditions. It's unwound, but only partially. So the level of the financial index now is still tighter than the historic norm. And that's a really important feature of where we are. Essentially, before the pandemic, financial conditions were priced on low for long. People believed we were in a chronic low inflation environment, requiring basically open-endedly remain at the lower bound as far as the eye can see. What we have now is a resetting. There's an anchoring of inflation expectations at the target. And we have not just the policy rate, but long rates, real rates, all of these have moved. The other point, if you stare closely at the last few data points of that, is there has been an easing from equity markets in the last few months. This is the dark green smudge below the zero line. But it's just, the equity market is just not big enough in Europe. It's not a big predictor of future output. So the contribution of the equity market to financial conditions in Europe is limited. So it's possible simultaneously to be concerned that the scale of kind of market pricing in the US is creating loose financial conditions and not have the same concern in the European data. And then the right chart is just basically saying this new index is comparable, if not a bit better, than some of the other indices. Okay, so that's one cross-check. Is our policy rate correlating with overall financial conditions? The second cross-check is, are we affecting the banking sector? The banking sector remains, super important in a European case. And again, when you get a chance, it might be easier to look at those graphs on the website to look in more detail. But basically here, the staff are looking at different easing episodes at different points in time over the decades. And the message here is we do have pass-through to lending rates to firms and to households. So we do have an effective pass-through. Let me say that's not obvious. The history of the euro area has been from banking systems that are not working properly. So if you have a banking system that's not working properly, it's not necessarily the case that the transmission to lending rates would have been so smooth. But one of the big payoffs over the last 15 years has to raise the capital ratios of banks, make them better performing, and what do we get? We get stronger pass-through into the lending rates relevant for firms and households. But let me emphasize that the decline in the lending rate since we started cutting rates for households, for mortgages, has not been that big. Because remember, mortgages are priced off the long end of the yield curve most of the time, unless you have a kind of a floating rate mortgage. And these rates, as I say, have had a permanent increase. Compared to being very low before the pandemic, they're now 2-something by and large. So there's been a 2 percentage point increase in lending rates, which it looks like it's persistent. So if you're trying to say, well, why is the housing market still in many countries fairly muted? Households have to get used to this world where the cost of a mortgage is much more expensive than it was before the pandemic. And here at ECB, there's also been work reminding you that some people have insulated themselves by having a fixed rate. But a lot of these fixed rates in Europe are 5 years or 10 years. As they roll off a fixed rate they took in 2019 or 2020, they face a higher rate. So even though we've cut the policy rate, many people in the mortgage market, when they refinance, it's more expensive. And again, that's a counterweight to easing. So what we have is essentially an interesting fact that essentially the left side is coming from surveys. We have seen a recovery in demand for loans from households. Not much from firms. So part of it is this new interest rate world, and part of it is look at the shocks facing the European economy in terms of trade, in terms of uncertainty, and so on, in terms of the Russia-Ukraine war. And so when you try to think, Are we back to normal? On the right side are these credit gap ratios. So some of this are in regulatory mandates to calculate a credit gap. But in general, it's a kind of a goal to say what is a kind of reasonable ratio of credit to GDP. And if you look at that distribution, it's mostly below zero. In other words, credit is lagging GDP in this time period. And the question is that suggesting either that we have this permanent shock to interest rates, or that it's just a lag, it's going to catch up, or have bank credit just become less important? So maybe you should look at non-bank credit, private credit, and so on. And it's simply a change in the structure of the financial system. Well, if you look at how firms finance themselves, and here we include all sorts of finances, not just bank finance. You can see from that graph, it's still pretty quiet. So if your conjecture was bank credit is muted because non-bank providers of credit have expanded, that's a very important story in the US. It's not zero by any means in Europe, but it's not big enough to replace the shift in bank credit. A very interesting issue, and this has been here for a long time, but now with new data sets, and again, I don't know how those of you in academia, how much you've been able to think about these new data sets, such as ANA Credit. So ANA Credit is a big data set, basically recording loans above a certain size across all sectors in the European economy. So you can now ask questions which you could not ask before. Now, there are other loan level data sets at different national central banks and national agencies as well. But if you look here, there's some clear patterns. So on the left pattern, what we see is a big difference between manufacturing and services. So one reason why credit has been muted is, of course, the manufacturing sector, both for equipment and for working capital, typically uses a lot of bank finance. But the European manufacturing sector has been shrinking in many places in recent years because of the rise of China, currency appreciation, high energy costs, and so on. So again, if you're trying to say, okay, it's monetary policy, where is it effective? It looks like it's effective more in the services sector right now rather than manufacturing. But within services, let me emphasize, it's really the green box there is real estate services. So there's a lot there in relation to real estate. And then the other graph on the right panel is indexing by size and riskiness. So what's happening under these conditions, which I think from the point of view of an individual lending officer makes sense, is credit is flowing to large firms and less risky firms. Probably a lot of incumbents. Credit is not flowing so much to smaller firms and riskier firms. So I see various people here teaching business schools, and I'm sure when you think about innovation rates, productivity, dynamism, if credit is not flowing to smaller and riskier firms, then the impact on the economy is going to be more limited. So again, this shows the value of, these were questions I think we couldn't answer years ago. Now we have, I think, important ways to kind of capture that. So in relation to bank loans to households, I said there's been, in the aggregate, a significant increase. Part of that is essentially, as we've cut rates, many households now can, it's interesting, some of the models used in kind of abstract macro seem to work when you think about demand for housing loans. So Tobin's Q, other user cost of capital works quite well for housing. As we've cut rates, it's been more attractive to think about returning to the housing market. But what you see here is two factors. One on the left, there are differences across countries because it's still the case the mortgage market is very national in nature. This may reflect kind of social norms. It may reflect legal incentives. But of course, the pass-through from the policy rate to mortgages will be faster if there's floating rate mortgages than if you have long-term fixes. That topic has been here throughout the history of the euro. People like Rudy Dornbusch in the mid-90s were writing papers about how will the euro work with this asymmetry in transmission across countries. And then the other innovation on the right is what we have now, which again, maybe you all are up to speed on it, but this consumer expectation survey. So every month we survey a lot of households in Europe. And this really helps us think about differences across income cohorts and other characteristics. So what you see on the right is there's a lot of asymmetry across income cohorts. I mean, the bottom quintile, they don't have the status to apply for mortgages. What's interesting is the second quintile has the biggest. And this can be interpreted actually more as a sign of financial pressure. These people have seen big increase in the cost of living, and so they really need to kind of find financing. Now, you might say that that's really part of an effective monetary policy transmission. These are probably high MPC households. So easing interest rates that have an impact on this group may be something that's quite important. Much less so at the higher quintile groups. I'm now going to get in severe trouble with my board members upstairs. So let me turn to some other factors here. One is uncertainty. I think you might agree measures of policy uncertainty have gone up, even if financial markets on the right don't seem to price that so much. But what I want to emphasize is uncertainty affects monetary transmission, both in terms of credit demand. Firms and households typically a lot will postpone decisions under conditions of uncertainty. But on the credit supply side, risk is a big part in our surveys of whether a bank is prepared to make loans on easy conditions or whether they want to hold back. So if you're working on how does uncertainty affect the economy, the impact of uncertainty on the decision, the credit supply decision, I think is important. I'm not going to be able to speak coherently about trade beyond saying on the right side, so far the message is banks are more nervous about firms exporting to America than firms importing from America. And again, we're keeping track of that. So again, if the question is, how does trade policy affect the economy? In addition to looking at real channels, looking at the channel in terms of credit supply is also important. So I'm going to maybe just finish with the effect of not just trade policy, but the exchange rate on again, banking systems. So Helen mentioned earlier on the work I did on external balance sheets. But a big part of external balance sheets are the balance sheets of the banking system and more generally the financial system. European banks have a lot of activity in dollars. The good news, it's on both sides of the balance sheet, so a lot of it nets off. But you still want to go bank by bank, item by item. And let me emphasize here, there is a difference in terms of funding. A lot of the liability side is raised from non-bank financial entities. So, one of the big discussions last week at the IMF were the interconnections between the non-bank financial system and the bank financial system. It's been stable and smooth, but, the financial stability wing, I'm sure, has to worry about this kind of dynamic. Okay, I've kind of bounced around there, but if you want the one sentence takeaway, which is, if you say, well, I carry around an elasticity that output or inflation responds to the interest rate by X. Okay, in the end, we do have that kind of macro elasticity, but behind it, we do really have to go meeting by meeting, because what I showed you just there is monetary transmission depends on the shocks hitting the economy. So those shocks have an effect on the real economy, but they also have shocks, impacts on how banks make decisions, non-bank make decisions. And this is why in our overall monetary policy strategy, maybe for those of you who are historians of the ECB, we used to have a segregated analysis. You'd study the real economy over here, and you'd study monetary aggregates over there. And it was like a cross-check. Now, 5 years ago, the strategic decision was you need to do it jointly because the intersection of macrofinance runs both ways. And so the overall message, and this is why probably the ECB is so happy to have this macrofinance conference here, is macrofinance is really so central to monetary policy. So with that, let me wish you all the best for the rest of today, but I now have to sprint. Okay, thank you.